Good morning, good afternoon, and good evening, everyone. And welcome to a family office webinar, How Family Offices Are Planning for Uncertainty. It's my great pleasure to introduce you to Doug McCarley and Alan Houghton, who are joining me for the call today out of Boston and New York. For those of you who don't know me, my name is Edouard Thyssen. I'm co-founder of Trusted Family, the leading governance platform for multi-generational family offices and family of businesses around the world. We work with about 200 of the world's most successful families. And as part of what we do, we also organize sessions with our clients and with partners to provide critical thinking and insights to our community of families. And so this is what brings us together today. So great pleasure to introduce you maybe in the first step to Doug. Doug is a partner at Cambridge Associates, one of the leading, in OCIOs in the world, advising, I don't know how many families exactly, but a large number of the world's most successful families on their investment landscape. And obviously in today's climate, with all the uncertainty happening around, AI, the geopolitical situation, we thought it would be a great way to bring everyone together and have a lively discussion. So maybe, Doug, you can say a few words about you and then also introduce Alan in a second step.
Sure, and I work at Cambridge Associates. We work with about 300 global families. I've spent about 30 years here partnering with a globally diverse group of families. For those families, we help develop asset allocation strategy, conduct manager due diligence and manager selection, and help build good governance. And we also get involved on a host of other family-related issues that arise every year: family education, trust distribution policy, liquidity analysis, that sort of thing. I work with a mix of entrepreneurial families as well as second, third, and fourth generation families. And one of the families I partner with is the Goelet family, where Alan Houghton is CEO. So I'll let him introduce himself. So.
Thank you, Doug. First of all, it's nice to be here. And we've had a long relationship with Cambridge as a partner, and we've also had a relationship with Trusted Family, who's been our platform for getting information out to our advisors and client families. So it's good to work with two partners. I've spent 30 plus years in the investment management or wealth management industry. I've been fortunate to be on several investment committees as chair or member, and also to be on several family office boards. So it's in private trust company boards. So look forward to today's discussion and to work with you, Doug.
Great. So
Excellent.
I am battling a little cold today, so I hope you all can understand me. So great.
Well, so just a little note, we had over 200 registrants for this webinar, which is one of our records. We have a very diverse group in the audience, right? So we have some very large families that are in the US, and so they are hence thinking in US dollar terms. But we also have a number of families from Europe, from Asia, and from the Middle East, where I've moved in January. And we also have a wide variety of stakeholders within those families, right? We have family members, we have next generation members, we have chief investment officers, we have advisors of those families. So I just wanted to give you that context so that we can go sometimes very technical, but sometimes also, quite wide. Maybe, Alan, for the benefit of the audience, could you give a quick high-level overview of sort of the family and the governance structure? Obviously, at Trusted Family, we really focus on how families make decisions, right? And in your role as CEO, can you share, the different boards or investment committees and how they function on a high level? And then we can go sort of on the investment landscape with Doug to sort of then have an overview of everything happening in the world and how families should approach the current environment.
Sure. So from a very high level, we have an office board of 7 people comprised of both family members and non-family members. And that's done, family has to have control because we come under the SEC single family office exemption. Under that structure, we have 3 committees, as a typical board would, that cover things like finance and audit and risk and compensation. And then the investment committee, which is germane to the day, is comprised of 8 members. majority non-family, but we do have family members on that committee. And our structure is a little bit perhaps not unique, but we also work with a series of groups of trustees in our decision-making matrix. So our decisions from investments involve both our internal investment committee, our consulting relationship, our investment committee, and also a trustee group.
Excellent. Thank you so much. So, Doug, I mean, let's not talk too much about geopolitics, but obviously, it's a very eventful year. There's a war happening in the Middle East. Stock market is nearly at all-time high. The concentration in the S&P 500 is also at all-time high. AI is shaking up the entire economy. So can you give us, quick overview first of like what you see happening and what are these discussion points high level with families? And then, also sort of share what are some of the things you see in the current environment.
Sure. Well, Edward, we just hit an all-time high this morning when markets opened again. So you're spot on with your comments. I think the word of the day is really uncertainty, and we have an incredible amount of uncertainty in the markets right now, but we have faced this many times in history, so this is not really that different. And I think today Alan and I wanted to walk through some of the areas where families are taking steps amidst this uncertainty, and these are 6 of the boxes. There's a lot more. We could have put 20 boxes on this page, but we wanted to highlight a few of the key ones. And I think it's important to say before we discuss this isn't about market timing. We all know that's a fool's game, but we do believe making modest tactical shifts, and those top 3 boxes are really investment focused. Making modest tactical shifts can be helpful to preserving capital. And then the bottom 3 boxes are really about changing behaviors or slightly altering behaviors amidst all this uncertainty and potentially a lower market return environment. So that's what we really want to talk about today. Maybe we can talk about the first one, which is shifting portfolio away from the S&P 500. If we just turn one slide, this is a theme, and this is a fun chart to look at, I think, for everybody, but this is the theme of sort of large cap dominance, what we're living in now. And you alluded to this, Edward, record concentration. Today, the Mag 7 represents about 35% of the S&P 500 index. If you look at that bottom right box there, that it's a little data, but it has not changed. Those are the top 7 stocks in the US stock market. And it is record concentration. We have had near this concentration in the past, going back to the 1950s and 60s. We had a very concentrated, even in the 1930s, markets were very concentrated. But over the long arc of sort of 100 years, the top 7 stocks have averaged around 20% of the market. So we're at 35 now. And there are also a lot of forces working against these companies. When you think about what's going on in the market, as you get larger and larger, it's harder to maintain that high growth rate. And they have, as we all know, massive CapEx spending. I think the 6 leading hyperscalers, Amazon, Meta, Google, Microsoft, Oracle, and Apple, they've gone from about 160 billion in CapEx spending in 2023 to 700 billion estimated for next year. So that's eating up 45, 50 to 80% of their operating cash flow. This is a huge change from companies that used to just have tons of cash on their balance sheets. Now they're starting to use debt. So I might argue their businesses are evolving more toward utilities. They're evolving from asset light, high capital efficiency to debt funded infrastructure businesses. And you've seen in the press lately, how long do these servers last? There's a debate, 5-6 years, you have to depreciate them. So there's an evolution here going on in this large cap space with the high capex. And I would just point out, if you look at the Mag 7 on the far left, year 2000, the broader takeaway of this whole slide is the lack of permanency of market leaders. And I would just point out year 2000 as an example. Microsoft is the only one of the top 7 25 years ago that's still in the top 7 today. If we tick down that list, GE went through a massive restructuring. Cisco hit a peak market cap of 555 billion in 1999. Then it fell 80%. I think this recent rally this year just brought it above its high. Intel lost the battle to NVIDIA. ExxonMobil, although it's on a rebound, it was kicked out of the Dow Jones Industrial Average Index a while ago. Walmart lost the battle to Amazon, and IBM lost the battle to every computer-making company in the world. It was the dominant early computing company, but it's the shadow of its former self. So, I think the takeaway here is that the companies we see today as the leaders likely won't be 10 and 20 years from now. We need to remember that, and it puts portfolios at risk if you're overly exposed to the S&P 500. Someone once said that being the dominant incumbent in one technology generation almost guarantees you'll be slow to cannibalize yourself in the next one. And that may happen here. So it's an argument for sort of shifting away from the S&P.
Hey, Doug, can I raise an historical
Sure.
perspective that I think the audience might have interest? I remember I went on my own family's investment committee, separate from my day job, in the early 90s, and remember sitting in an investment committee meeting, and GE was roaring, and we had some very seasoned members of the investment committee, and their view was, well, we can invest in GE and get all of our emerging markets exposure because they're a proxy for sales to emerging markets. And it was just very interesting how wrong that bet ended up being. If you fast forward that decision about, was GE going to be that proxy, was GE going to be in that same index again, and how long that absence would be. And you can get caught up in that moment of whether it's GE in the 90s or a stock today, and you can end up, it can be outpaced by something. So it's just a reminder, investing in the moment.
Definitely. Another, and maybe we can turn to the next slide, another sort of theme we see families doing, and it's really at the margin right now, is tilting their portfolios from growth to at least neutral, and in some cases toward value. This chart shows the performance of growth equity manager medians and value equity manager medians. When you see the sort of blue columns above the zero line, that's when growth is outperforming. And when the tan is above the zero line, value is outperforming. This chart only goes back to 2010. If you brought it back to the early 2000s, you would see a period where value crushed growth. I mean, the tan was way ahead for basically a decade. From a valuation perspective now, U.S. growth and value stocks are both trading at very, very high levels relative to history. So this isn't really an argument to say, sell all your growth and buy your value because it's cheaper. They're both very expensive. It's just a note to say growth is won now for probably the last 10 or 11 of the last 15 years, and it doesn't always win. And so this is a note to sort of point out it may be time to look at your exposure and shift slightly from sort of the growth stocks into value, or at least be neutral. Another slide, I think the last one on the investment side, I think we should discuss is that families are thinking about a lot, is prepare for dollar weakness. And I know some of you are outside the US and in non-dollar primarily, but this chart shows the valuation level of the US dollar versus a basket of OECD currencies over time and how that dollar is valued. This kind of mirrors the dollar performance cycle as well. When you look at the dollar for the past 10, 20, 30 years, it goes through these 5 to 10 year cycles where it drops 60, 70% relative to a basket, and then it goes up 60, 70%. And those cycles are pretty consistent. You never know when they begin and end, but they tend to last for quite a while. Right now, we're at a dollar, near a dollar peak period. We've had a dollar weakness for about 9 to 12 months now, but the dollar still sits in the 85th percentile against a basket of developed market currencies, and it's in the 65th percentile against a basket of emerging currencies. So while that's down from its high, it does point to a period where we have higher risk in the dollar. And I'm not a betting man, but if I were to bet, I would say that it's more likely the dollar valuation will fall, and that being in non-US currencies would be a tailwind to an investment strategy. And I'm not a believer in charts. There's an old saying that there are a lot of captains lying at the bottom of the sea who relied on charts. And that's true, but this one is pretty telling when you see these big cycle waves, and we're at a peak now again. Now, what factors are working against the dollar? There's U.S. fiscal challenges, potential loss of confidence in the dollar because of the independence of the Fed. The dollar's share of reserve currency is in decline. It peaked at over 70% in the early 2000s. I think today it's around 50%. So one example of that is China has cut its holdings in treasuries almost in half over the past decade. And a growing share of world trade in oil is settled in yuan, the Chinese currency now. So while we're not arguing that the euro and the yuan are going to replace the dollar, it certainly is becoming less of the global standard for currencies slowly over time. And if that continues and we continue seeing treasury selling and other currencies rising up, we can see this dollar start to fall. Maybe this is the last, and I don't know, Alan, if you wanted to comment on this then before we turn to sort of the sort of softer topics. But
well, I think what's so interesting about this chart, Doug, in relation to your prior one, is if you look at kind of if you were a globally diversified portfolio over the last 10 or 15 years, and there was anything you did from a US perspective, diversifying out of dollar-based assets, you took it on the chin on a currency basis. And many folks don't hedge their equity risk, at least from the US. So you would have had a perpetual drag from the dollar being so strong, dilutive from the non-US investment position. If you're on the other side of the pond in Europe, you got the reverse, right? You picked up U.S. equity exposure and then stronger dollar, and so you've got a real headwind, and how that will reverse. It's interesting when you look at, Doug, we've talked a bit about this, the role of emerging markets when you adjust it for, or non-U.S. investments when you adjust it for inflation. Do you get compensated to hold that exposure for extended periods of time? And I think we're at peak pain time now that I think many investment committees are saying, well, how much non-dollar do I want to have? And when you look at these charts, what's so interesting is what are the views as far as, are you being compensated now? And what role will currency play, Doug, in the pickup in places like EM that gets translated into a large enough premium that makes sense to diversify into emerging? And I say that as somebody whose reference currency is the US dollar. And I know from my friends that live in emerging markets and other places of the world, that's a luxury sometimes you can't assume. And it depends where you live, your asset allocation can be demonstrably different. So, Doug, this comes back to the discussion we've had about globally diversified portfolios and what currency are you spending in?
Right. And this chart, look, we often say that consensus is often wrong. But when you look at this, and so we can take this with a grain of salt, but these are major asset management firms and banks, and their forecasts over different periods, they each use different time periods, their forecast for US, non-US, and emerging markets returns. And it's pretty telling that every single firm believes the US will underperform non-US and emerging markets over the next 5 to 10 years, depending on the forecast period. The Cambridge Associates one at the bottom, I just want to point out, is not a forecast. We're either too smart or too dumb to make a forecast. That is a statistical exercise where we say if market valuations were to return to normal, so long run median averages, what would the stock market have to do holding earnings growth at a constant rate, over its history? So the stock market would have to return 0.6% a year for 10 years to get the median level valuations. That's the sign at how overvalued equities are in the 95th and 99th percentile, depending on what metric you use. But this is the takeaway to make your portfolio more globally diverse. If you believe the research for a lot of these firms these are firms that are largely U.S. based and believe in the U.S. market generally, and they're saying, no, it's time to start diversifying outside the U.S. So there are other areas. I think we've talked a little bit about the investments shift away from the S&P, move from growth to value, or at least to neutral, and make sure your portfolio is globally diverse. But there are 3 other sort of softer topics I think that Alan should cover. If we go back to that main page, Edward, at the front, the 3 bottom boxes. There we go.
Yeah, it's interesting when you think about where can you add value, and I think if you take it from a high level, when you think about if you're worried about the markets, what are you trying to mitigate, whether you're an investment committee and policy or allocation, right? You're usually dealing either I'm worried about liquidity, I'm worried about leverage in my portfolio, maybe I'm worried about the beta or the correlation to my asset mix. And to Doug's point, maybe U.S. non-U.S. dollar or, exposures are a key thing that I think if you're looking for a high level, an investment committee level, you might be thinking about. The challenge is most people start focusing on things like the future when something goes wrong, as opposed to trying to come up with your plan when things are relatively calm. It's very difficult to make thoughtful decisions if the markets are going down 20% and people are willing, you should rebalance into an asset class, but you're fearful that and so I think the key thing is have a plan well in advance and talk a bit about these exposures over time. And this is where the governance comes in. So, there's always the expression, don't let a good crisis go to waste. And that can be optimized if you have a thoughtful structure. And sometimes, unfortunately, people focus when they're in those things about from an investment committee at the manager level, when you need to bring it up a level and focus on strategy and risk exposures and liquidity and all those really top level things, not quite as attractive as the manager level, but equally important. It's hard investment depending on how do you optimize a complicated structure. That is incredibly hard. How many people do I have on my investment committee? Family, non-family? What's the optimal size? And many people say the optimal size for an investment committee is about 2 or 3 people. Once you get to 5, 6, 7, it's a little bit more cumbersome. But I think the beauty of for families, if you can get the right mix between family members and non-family members, focus on high-level topics of strategy, I think you have the highest outcome. And so it's a combination of people and process that is so important to drive outcomes and allow you to deal with the things that Doug's talked about on the first page, which are how do we feel about S&P concentration or tech concentration, things of that nature, in a very thoughtful way. And you've got to be talking about those issues all the time. And so I think that's a key oversight. One thing you can do on the 2 right boxes are what are the things you can do at all times to think about the inputs and the outputs. So remember, when we think about, we use this kind of bicycle analogy in my world, one tire is what's generating the returns. And then the other tire is what everything the family spends over time. So those are fees, taxes, distributions. Those need to be in sync, and you need to kind of pedal efficiently. But the one thing you can do at all times is you can think about, the role of indexing, the role of fees. Can I negotiate better terms? And this comes back to a good crisis. You can often get the best terms once you've had a downswing in the market. You can access better managers on the private side, hopefully, if you're thoughtful, in that nature. And how do you focus on having a realistic spending profile for the family, whether you have an operating business generating dividends or you don't, you live off the investment portfolio. What should be your steady status first, continuous, basically, what can we spend and not ever put the portfolio at risk? And I think that's something that, Doug, your clients and many families do is what's a sustainable spending rate or what we, fees, taxes, and distributions that the portfolio can absorb over time. So you're never in the position of being reactive in a negative way. You can be proactive in a very positive way, whether it's renegotiating with a manager, thinking about a thoughtful reallocation. And that is very difficult to do, much more difficult to do from a family perspective, from an investment committee perspective, if you're over your skis in one part of your portfolio, and then you're forced to make other decisions. So I think kind of a takeaway here, you have thoughtful governance and you're spending time at every meeting thinking about policy issues and bigger issues. It takes the pressure off and making sure your portfolio is aligned with your family's capital and spending needs over time.
So maybe one question, right? I really like your point about sort of strategic plans, and obviously you work with a very large multi-generational family, right? So you think in generations, right?
Yeah.
I think the point about you look at sort of, the top 10 stocks 25 years ago, it's interesting to look at it that way, right? Like that's roughly the time of a generation, right? And so, one part is designing that plan of hey, as a family, what's the type of long-term vision we have, the type of return we expect to be able to, just sustain the growing number of family members, right? But then at the same time, it's interesting, right? Some of the points we discussed in the first part here with Doug is how do you make tactical decisions to actually change the asset allocation, right? now we're seeing this S&P 500 concentration, right? I mean, it's been going up. I'm sure that 1 year ago it was already a topic, right? Because it was going up, right? Can you actually share, like, in practice, how do you get like a large number of stakeholders make a decision and be like, hey, now we actually change the asset allocation, right? Or we allocate more to value than growth, right? Can you sort of share a few examples or perhaps stories?
Well, we've done that here, Alan. You should touch on the small cap edition, and yeah.
Yeah, and that played out over time. So I think two things that I can share kind of practically. One, starting 2 or 3 years ago, we thought about the addition of more small cap exposure and how should that be structured in the public side of the portfolio. And that was a discussion that went for a while, but it involves a lot of education that leads up to that. So you can move relatively quickly, as fast as committees can move. I'd say the corollary on that is thinking about, when you look back 2 or 3 years ago and you started seeing or 4 years ago, some of the pricing in private equity. Then there's the question of, do you think about the mix of your private equity managers, those that are paying too high multiples for certain types of businesses, more value-oriented managers, which you do see in some of the buyout strategies. And that led to discussion about how do we think about tilting the portfolio going forward. So and obviously correlations between public and private. But that thesis wasn't something that just erupted in 2023 or 24. The problem is it's in a sustained bull market like we're in. If you get to the later innings, it can keep on going, and it just and then it gets harder to make that decision when you should be trimming your ones that have done so well and putting money in the underperformers. But it's very difficult for an investment committee to say, we're going to put money in the worst performing of our managers because we think cyclically that they're about to turn up.
Yeah, and I think where a lot of families we work with, Edouard, you see small and mid cap allocations growing modestly, and I would say it's modest to start. You also see diversifiers or hedge funds coming back into popularity to some extent, not like they were in the 2000 period, but some families are moving a little bit, and that might be 1 or 2 percentage points from US large cap into hedge funds, on the belief that we probably, given that we've just come through a 15% compound period over the trailing 10 years for the S&P, we're probably going into a decade where it's single digits. And what would look good versus single digits? Maybe a hedge fund basket, maybe even fixed income. So make sure you're not overweight that S&P if you really believe we're going to be in a lower market return environment. And that goes back to what Alan was saying. I mean, when you're going to earn, we do earn 3, 4, 5, 6, 7% on the S&P for 10 straight years, you have to be tax efficient. You have to manage your expenses, and you've got to cut your spending some way if your goal is to grow that purchasing power of the assets. And Alan touched on this, but I just reemphasize the access in the private world now is growing significantly. And I wouldn't say the tier 1 managers are all open. The very tough to access are still very tough, but it's the tier 1B, tier 1C, those very good managers who previously were tough to access, and they're not the absolute top tier. They are now starting to open up. And part of it is some of the major universities, foundations, and families that would commit 30 or 40 million at a time to each of these funds. They're still committing, but they're cutting back their commitment to 10 or 20 million, given their over allocation to privates, and it is freeing up some capacity in those very best managers. And this is the time to really upgrade your portfolios. So, should we turn maybe to the patch, the quilt? This is slide 7. We can go there. I think this is we've talked a lot about asset classes rotating and shifting around. Warren Buffett has a saying, which you've probably all heard: the rearview mirror is always cleaner than the windshield. And basically, investors like to look back as they drive instead of looking through the front windshield. The vision is very clear on what just happened, and there's a tendency to believe that what just happened will continue. And I think it's really important to look at a chart like this, and you've all seen these charts before. It looks like a quilt that my mother makes, and there's really less of a pattern in sort of returns. You'll see some periods where asset classes win for a short period, and then they reverse almost to the bottom. If you start on the way left of this chart, you'll see venture capital is at the very bottom. And actually, if you pull the chart back further, it that was about a 4-year period, 5-year period where from 2000, where it was at the very bottom. And then it had a good rise up to the top. You can see in the upper right of the chart, venture was winning. It was sort of the winner in sort of 5 of those 7, 8-year periods. And then what we're going through now, venture has been sort of at the bottom again. And we may see a wave of IPOs, which will pull venture back up again. So this is a very cyclical asset class, but so are many of the other asset classes on this page. And one thing we've done, if you look at the two right-hand columns, we've parsed out the asset classes and in sort of a decade and a half. So the right-hand side is 2010 to 2025, a 15-year period. What was the top asset class in that 15-year period? Well, it was venture. Everybody is shying away from venture now. It's been pretty tough, but for a 15-year period, it won the day, followed by U.S. equity, private equity, and what was at the bottom? Emerging markets and commodities. If you look back at the 2002 to 2008, and you could really pull that 2002 back to 2000, it would show the same story. Emerging markets won. Private equity was quite strong, and the worst two asset classes in the world, U.S. equity and venture. It's a 6-year period. If you pull it back 2 years, you get an 8-year period where the story doesn't change. 1 to 1.5% returns in U.S. equity and venture. We're not saying that will happen again, but it could. And so the important thing is to make sure you have diversification across all of these assets, because what is won recently is almost less likely to win, given that reversion to the mean is a very powerful force.
Maybe one question. We have a number of families here where honestly, perhaps 75% of their total net worth still lies in one underlying family business, right?
Mm-hmm.
And so how do you put that in the equation, right? I mean, you look at that, the last 15 years, basically US tech was sort of the winning investment, right? And so if 75% of your net worth is in an old school industrial family business that's been around for 3 to 4 or 5 generations, you're probably underperforming versus, US tech growth kind of, right? So maybe Doug, obviously, you see all these families, like how do you handle these discussions with families about asset allocation? Also, when there is sort of a legacy important family business kind of, right? You reinvest the dividends in the main business to grow it. You sort of take some of these dividends, put them in an investment office and diversify. Like what's your view on that?
Yeah, I think this is and Alan should comment on this too, because he's faced this many times. It's different families, but my take on this is it's first a very difficult conversation. I have some families that I use the phrase, they don't want to have a conversation about having a conversation about selling the business. So it's sort of the third rail. You can't go there. But many of our families, when they come to Cambridge, they've made a decision to diversify their portfolio, and they look at it as their family business is in their left pocket, and they say, well, we need to build some assets in the right pocket, such that if the family business ever does start to fail or weaken, we have another anchor to keep the wealth going and preserve the spending power for generations to come. And so, as you said, Edouard, many families take a share of their profits and whatnot, and they diversify that. They move it from that left pocket business to the right pocket. The challenge is many families, their businesses require capital to keep it going. And so the amount that they can take out of the business to diversify is small relative to the size of the business. And that becomes a challenge, because that profit distribution from the business is also supporting the family's lifestyle. So we work with families on that, but it can take years to properly diversify. We actually have a chart, and I want to turn to Alan because he's going to have some examples, but we should turn to the comparative asset allocation too, which is slide 10. Yeah, this is a chart showing, and I'll just focus in on the business owning families first. This is a chart showing how families are allocated. There really is a push for many of our families that own businesses to have diversification outside. That business owning line represents our families that have at least 50% of their wealth tied up in their family business. And we tried to show here, what do the rest of their assets look like? How are they diversified? One of the biggest takeaways on that line, though, is even though families are tied up in a private business, they still do private investments like venture, buyouts, growth equity outside of their business, and why, just as you pointed out, many of them have old economy businesses, industrial businesses, consumer businesses, and they don't have exposure to technology. They don't have exposure to energy. They don't have exposure to other assets. So that private diversification, private investment diversification gives them that exposure and acts as a complement to their private business. So, but Alan, maybe you could comment on your experience with families.
Well, it's interesting, Doug, and if you've had a family businesses, by definition, if you've gotten to the point fourth or fifth or sixth generation, then they've been successful, and their compounding rate is almost always higher than what you're going to get from a public company, either because of operational leverage, efficiency, market leader. So the first thing is, if you're diversifying and taking into another business, it is very difficult to think that you're going to compound at the same rate and in the US, tax efficiently as you do when having one business, which gains are only realized periodically when you're monetizing those assets. And so I think there's a expectation of what is the private holding going to do, and then what is the portfolio going to do, and then when you blend them together, what's the expected return? And to Doug's point, either the operating business is generating portfolio income and dividends, and therefore the portfolio doesn't need to, or if you're selling out of the family business that provided dividends, then you have to think about how you replace that income stream. And so that is a choreography that needs to exist. Particularly if you're exiting over a multi-year period, which many families do, is how do you think about that? But you should never expect the return. And this is the hard thing. The risk that families have, and my family had an operating business in the manufacturing world, the risk of that, even if it's public, can be diminished versus the public markets, which they don't understand. So this is the key question. I know many families that said, I just feel so fearful of the public markets. I don't understand hedge. I don't understand that. So they need to think about, who they put around their advisory group, how do they think about it, and make sure there's always a connection between you have a legacy business and the portfolio, that there's an understanding of what should be the expected returns for all those components going forward. And I think this is one of the most complicated areas that families get into when they're bridging, particularly a public asset or a private asset in a family holding company in the public markets. And so it depends how you staff your office, how you staff your investment team, and then how you model all that out a decade or two, which is the key issue. I've been involved with several families who have gone from either family-owned businesses or concentrated asset pools to more diversified pools, and those are very difficult journeys because you look at the success of what has already been in place for 50, 75 years. And you just got to moderate your expectations as you move to non-core assets.
Well, one other thing, Edward, I wanted to, while we're on this topic of diversifying away from a family business or adding diversification element, this chart here represents 300 families that we work with and how they're allocated, and we've bucketed them by family size, as everyone can see. At the bottom, we have 10 very large endowments. There are a few that are missing there that we don't have data for, that don't allow us to, well, we have their data, they don't allow us to share it. So the Harvard, Princeton, and Yales, but these 10 are some of the largest institutions in the US. But I think there are key takeaways on this slide when you look at all of these families and institutions. The biggest key takeaway is where you're highlighting the fixed income and cash. If you add the fixed income and cash in both cases here, it ranges between 7 and 16% in some. So those two teal right columns, 7% being the endowments. They hold very low fixed income and cash, and 16 is one of the sort of family subsets. That's pretty low. That really means the families are holding families and endowments 84 to 93% in equities. Now, some of that equities is in diversifiers. This ranges, if you look at that green column, diversifiers or hedge funds range from 11 to 17% among these different categories of investors. That's pretty substantial in hedge funds, particularly considering the conventional wisdom that hedge funds are not very tax efficient. Now, some don't pay taxes if you're offshore outside the U.S., and there's certain elements of that. But within the U.S., there is actually a belief, and we've run the data, some of the hedge funds are not as tax inefficient as one would have thought, partly because a lot of hedge fund portfolio managers have their own capital in their fund. So they're making decisions on the margin to be more tax efficient. But I think that's a big takeaway, is the hedge fund allocation is pretty substantial. The fixed income and cash is quite low. There's also a pretty low allocation there to real estate. I would not put too much weight on that. Most families don't put their homes and some of their directly held properties into their Cambridge asset allocation view. So it's probably understated as a percentage of total assets, that sort of private real estate number. But those are the big takeaways out of this sort of exhibit. One other. Go ahead. Yeah, sorry.
No, just a point also back on the family dynamics, right? I mean, I see it in my own family and a lot of families that we work with, a trusted family, because people live longer. You easily have sort of three generations of adult family members sort of working together, kind of, right? And at the same time, there's a massive wealth transfer happening all over the world, right? I'm just curious from both of your perspectives, like, how are you seeing these like generational differences play out in sort of the long-term strategy, in the asset allocation, in the selection of certain asset classes, kind of, right? So I'm just curious if you have some stories or anecdotes on that, right?
Well, it's interesting. I was on an advisory committee a couple of years ago with two of my uncles on something, and they refused to sell holdings to rebalance to model, and that had really expensive consequences over time because they let taxes dictate an optimal return. And it really, you could look back and go, what was the cost of that? As opposed to saying, we're going to pay 25% tax to diversify this portfolio. And there is an example, and I think there's a sensitivity, at least in the States, about what is my after-tax return, what's my cost of migration, what I have to earn in the new asset to make up for the opportunity cost, versus, so you have to look at that trade-off. And I think that's particularly difficult. But to Doug's earlier point, if you're disciplined, and I'll play that out today, you think about what role is technology playing in the S&P and the role of indexing with all the retirement plans, auto enrolling in some of these options. That can be some self-fulfilling prophecy, very fee efficient, very tax efficient. But what's the implication if you're overloaded in tech? And so, that's the hard thing sometimes, thinking about diversification. There are some asset classes, Doug and I have talked a bit about it. Some asset classes, if you're a taxable investor in the private side, make a lot less sense than private equity does. I mean, Doug, you've done work on real assets, particularly real estate funds, and whether they're worth for a taxable investor,
Right.
And those are kind of living examples. Doug and I were also talking, the decade that you grew up in, you cut your teeth in the investment world, has an impact on how you view risk and allocation. So Doug and I, my first day was in the 1987 crash. My first day of working was during the 1987 crash. That probably has influenced, as an investor and allocator, how I think about full markets, things of that's differently than people maybe that were raised in the last 15 years. And Doug, you might want to comment on that.
Yeah, and I think that's a really good point. The last 15 years, as Alan notes, have been a tech-driven boom. So we see a lot of the younger generation very focused on technology. They don't remember a time when technology doesn't win. They don't remember a time when value wins, when energy wins, when small cap companies win. So families and investment committees need to constantly remember there's bias from the decade you cut your investment teeth and pull that bias out of yourself and out of the people around you, and remind people that all investments are cyclical and they win and lose. So we're seeing a lot of tech, a lot of love for technology, a lot of love for impact. This generation is much more impact and socially responsible. Interestingly, I don't want to generalize an entire generation, but the young family members among a lot of my families, and I work with 16 families, I am seeing their consumption is a lot lower. They're buying fewer items. They're more interested in experiences, and so it's possible we'll see spend rates, distribution rates decline because it's not kind of viewed as much materially as let's accumulate these assets. Some of the children, look at their parents with many homes, and they don't want to have that lifestyle. So there are differences in this generation that I'm starting to see. But it all, to me, comes back to the simple equation when you look at generational wealth. your total return of the portfolio has to be greater than or equal to the spending, the taxes, and the inflation. And you've got to bring it back to that simple formula. And you look at the growth of your family, and your assets have to keep pace with that. And that's the most critical thing. And you do that by risk control. Alan mentioned rebalancing. If you don't rebalance, the market will do it for you. So you got to manage that. One thing, Eduardo, just I know we're running out of time, but there's one slide that I think would be really helpful to walk through. We started this conversation with uncertainty. Yes, this slide. We started, the word of the day is uncertainty. And there is a lot of debate now about liquidity. There are a lot of families who have high privates. We've been in the distribution desert as far as money coming out of those private investments. And I wanted to share this chart that we've done, and we've done this also for Alan and I've worked together on this, and I've done it for other families. The way this works, it's a very simplistic chart. So everyone could do this chart for their family. It's a basic model that assesses how much liquid defensive assets does a portfolio have to pay its expected outflows. So the way this works is first you isolate the defensive assets. That's the blue columns on the upper left. Cash, fixed income, liquid diversifiers. And what do I mean by liquid diversifiers? Those are hedge funds that have quarterly liquidity, not gates that could gate you, not 3-year rolling lockups. You only put in that bucket quarterly liquid hedge funds. Then you put in your fixed income and your cash in that far left current allocation bucket. If you have gold, you could add that in there too. Then we discount the hedge funds because we have to assume the market goes down. We're kind of stress testing in a way. So you take a haircut to that liquid diversifiers and you get an available liquidity column, which is in the middle, that blue column. And that's a certain percentage of your total wealth. So in this case, this is 19.9, 20%. Then what we do is we say, what are the outflows in a given year, just 1 year of outflows? And those outflows are included in the expenses that you pay at the total portfolio level. This is direct expenses you pay out, the taxes you pay. So you can use a rolling 3-5 year average of your taxes to kind of figure that out. Your distributions to your beneficiaries. And then the tricky one, the net private investment cash flows you expect. So if you're expecting to get distributions, factor that in. If you're expecting capital calls to be greater than distributions, factor that in. And you'll come up with a number and a percentage of your total portfolio that is your expected outflows. You should add dividends back in because you get those from your equities, even in a crisis. That total outflow then is, you basically divide your liquidity by that total outflow to sort of get the years of outflow you have available for you. So if you have 100 million of liquidity and you need 20 million a year, you have 5 years of available cash. Generally, we think the minimum target you should have is 3 years. Anything less than that, you're flying too close to the sun, because the average bear market, it takes about 3 years to trough and then recover. There are certainly bear markets in history, 1929, the 70s and high inflation period, even the dot-com bubble, it took longer to recover. But the average bear market, if you have 3 years of really safe liquidity, that's your backstop. You can always turn to your public equities and your semi-liquid diversifiers as a secondary backstop. But this will keep you from forced selling equities when they're down 30 or 40%. So it's a helpful exhibit to run. Go ahead.
Excellent. I just want to also open the audience.
Sure.
If some of you have questions, you should have a Q&A panel where you can ask questions. I'm checking up on time, but we can try and answer some of the questions here live during the call, or if not, we can follow up separately via email. Perhaps Alan and Doug, looking into the next 12 months, what's top of mind right now? What are you working on? What's the focus that you're seeing in this space?
I would say there's 2 things on my mind. One is we're about to potentially get a real wave of liquidity in privates with these IPO filings. I think there's there's a sense of kind of blissful ignorance right now going on. Valuations are running up. Even without a full deal in the Mideast. And this blissful ignorance is, just pushing stocks higher and higher in anticipation of those IPOs, and there's a lot of euphoria. I went to Claude the other day to define blissful ignorance, and Claude says it's like having an amazing meal without realizing how unhealthy it is for you. And it feels like that's what's going on in the markets now. We're just enjoying this ride. The music keeps playing. Um, Hopefully those IPOs go off and there's a lot of liquidity that comes, but there could be a lot of disruption too, because these are big companies that are going to take market share in those indexes from other companies. And so we'll see how this all plays out. I think the only thing we can count on is a lot of volatility with that. But nonetheless, we're hoping it plays, because there's a lot of families that are sitting on these private companies and venture portfolios and really counting on that. Go ahead.
My top two things are the US dollar declining, potentially substantially, inflation staying elevated. And if it stays elevated and we're at peak US market returns, it means our real returns are likely to be much lower for the next decade. And we need to come back and rationalize that because we've had the benefit of excess real rates of return over the last decade. And so that's a mindset change as far as, to Doug's point about spending and capital needs of families. I think one of your members asked, what's the difference with an institution? And I think I'll let Doug take this, but I think one of the big differences between families and institutions or an endowment, Doug, you worked with some endowments, is endowments always have money coming in usually.
Yeah.
To replace some of the money that's leaving for their spending rates. And I think in some cases that's not necessarily true of family enterprises or families who have divested out. They may not have a steady outflow or inflow. And so I think that's a big difference. I think in our world also, taxes are very different. And so there's a tax implication for those decisions, which if you're a university endowment, you don't have that same tax drag.
Yeah. And then one question that came in, obviously this is for we've mostly talked from an established family office perspective, right? Yeah. Imagine a family just sells their business, gets $100 million tomorrow.
Yeah.
How do you start, right? You have nothing, no investment committee, no sort of experience investing, no data of how markets have performed, the last 15 years. Doug, I'm sure you get a lot of these types of requests. Any advice, any insights?
Yeah, the first thing is, as Alan alluded to earlier, get the governance right. The best laid investment plans fall completely apart if you don't have good governance. I would get an investment committee of people people you trust. It doesn't need to be all investors. It should be people who are good at leadership, good at governance, some good investors. Put them on a committee. Get some outside advice that's independent, that's not paid in a way that's a conflict, and build that team around you to sort of say, how should we structure this? And then from an investment standpoint, I think it's go slow. The averaging in, if you've sold a business, and we have a few families like that, they've sold a business, they're sitting on $1 billion of cash. You've got one shot. You put it in all at once. It could be very impactful in a negative way or a positive way. But do you really want to take that risk when you have that one shot? In my view, the better way to do it is be very disciplined, be dogmatic about it, build a program and say we're going to average in quarterly. Maybe it's 4 quarters, maybe it's 8 quarters. But also put in triggers. If the market goes down 10 or 20%, we're going to accelerate the plan. But put that in writing. Put an investment policy statement together, map it out so that you don't let human emotion get in the way of that plan.
And also ask this, what is your strategy? And if you're divesting out of an operating business and that process takes several years, as an example, you should be asking at the beginning of the sales process, not the end, what do we want to do with this? What are the implications? Do we want to have an office? Do we have a different committee? Do you parcel your money to advisors differently? Do you set up your own operation? But you should be having that talk about strategy and where it's going to go at the very beginning of that process in a very thoughtful way. And how do you oversee it? And it's very different. It's very different mentally if you've been selling, $5 million a quarter, then all of a sudden you're selling 250 or 500 million or 750, and that's the bulk of your family's assets. That raises the awareness, and that should be a conversation with all family stakeholders who are going to benefit from that family pot. going forward. One thing, if I could, that families do on portfolio construction that are successful, I think they separate. If you have $100 and you're going to need $20 or $30 to live on, and you're going to need $70 to growth, is sometimes thinking about those as two separate buckets allows you not to get scared about the $70 or $80 that's in your growth bucket, because it's almost immunized. We've seen that as what we call whole net worth planning, is what some advisors call it. But that practice of segregating assets into buckets of what you live on and what you grow and goes to the next generation, I think prevents you from reacting in ways detrimental to the family's long-term growth objectives.
Excellent. Well, Alan, I want to say a big thank you for being so open here on this webinar and sharing all these insights you've accumulated over years of family office leadership. And it's always great to have like a live case study. Doug, big thank you as well for sharing sort of these insights, because it's truly unique to have the investment data and investment analysis you have over 300 families. Trusted Family shares many clients with Doug's team and sort of the wider Cambridge Associates group. So we love doing programs together. For all our clients on the line, a big thank you for your trust and for joining us today. For all the new families that have joined here as well, super nice to engage. If we can be helpful, we can connect you with Doug if you need specific investment framework advice, if you need an operating system to help you make good decisions and manage all these complex family dynamics we've talked about. Trusted Families there. And if we can also match you with other families, as part of your journey, we're there to help, because the best way to learn is to learn from other families, how they've gone through the same challenges. So a big thank you, everyone. Have a great day and speak very soon.
Thank you.
Bye-bye. Bye-bye.